Hello and welcome back to AI Market Insights. Is the AI rally finally over? That question is sending shockwaves across the US stock market right now. Just yesterday, major tech giants released their earnings, and the results were stunning. Oracle plummeted over 10%. And even the closely watched Broadcom, despite reporting solid results, saw extreme volatility and ultimately sold off. What exactly is driving this dramatic shift in the market? And why is a good earnings report no longer enough to support a stock price? Today, we're going to break down the one number that institutional investors are obsessing over. If you miss this key metric, you will misjudge the future moves of not just Oracle, but also players like Nvidia and other major AI stocks. Stay with us, because this is the difference between a panicked trader and a well-informed investor. First, let's look at the company that shook the market, Oracle. Their revenue did miss expectations, sending the stock tumbling nearly 15%. But here's the critical point. What truly spooked investors was not the revenue miss. It was the abnormal increase in their capital expenditures, or CAPEX. Oracle announced they would ramp up their AI infrastructure investment next year to an unprecedented $50 billion. You might be thinking, isn't investing in AI a good thing for future growth? Historically, yes. But the market psychology has shifted. Investors are now asking a very real question. They're taking on massive debt to buy AI chips, but are they generating enough return on that investment to justify the immense cost? The moment the market shifts from seeing AI dreams and hype to focusing on the real-world fear of costs and debt. That's what the Oracle shock was all about. And this fear immediately spread to Broadcom. The company's earnings report was actually quite good. Revenue beat expectations, and their AI-related sales were booming. That's why the stock initially popped right after the announcement. But it quickly reversed course and sold off. Why? There are two main reasons. The first is contagion selling. If Oracle and other hyperscalers are struggling under the burden of massive AI investment, the market fears that they will cut back on future orders from suppliers like Broadcom. The second reason is margin erosion. The custom AI chips Broadcom produces are selling incredibly well. However, they inherently carry a lower profit margin compared to Broadcom's traditional, high-margin software business. This creates a dilemma. The more AI chips they sell, the more their overall company margin, or profitability, comes under pressure. This is a massive concern for growth-focused investors. So, what does this mean for us, the investors? Look at the broader market movement yesterday. While high-growth tech stocks were sold off, sectors like banking and industrial stocks, the old economy, were bought, pushing the Dow Jones to new highs. This is clear evidence that capital is shifting from riskier AI bets to value and stability. The AI bubble hasn't popped completely. But the phase where any stock with AI in the name goes up is over. We are entering a new era of stock selection where profitability, or the ROI on CAPEX, will be intensely scrutinized. Companies like Nvidia and Broadcom remain powerful, but short-term volatility is a certainty. Do you see this current correction as a buying opportunity, or do you think it's time to rotate out of tech? Let me know your thoughts in the comments below. This was AI Market Insights. Please subscribe for more institutional analysis.